So, I want to talk to you today about some problems that directors face after they go into insolvency. And I'm going to give you some real life cases because I think it's really important that you, as people who are watching our content, some things in insolvency can go wrong very, very quickly. And the key thing is, it's when a director doesn't tell the whole truth. And I know it must be so tempting. You are, or essentially, you're being investigated by a professional licensed insolvency practitioner. And the directors might be tempted thinking, well, I'm not going to tell them about that. I'm not going to tell them about this. Hopefully they won't look at that. And the reality is insolvency practitioners, that is their job, is to investigate your conduct as a director. And if they find any wrongdoing, what they will do is they'll look to take an action against the director. Now, I'm not saying that this can be completely avoided, because if you are found to have done things that you shouldn't have done, then there's going to be an action. What I'm hoping is, if you're watching my content, I'm educating you enough to either pick the phone up to me, that'd be a good idea, or you are educated enough to have a conversation with an insolvency person and you know what questions to ask. So, big issue at the moment, I've gone on about this 101 times, is overdrawn directors' loan accounts. Now, overdrawn loan account, essentially what it means is you as a director owe the company money, you go through an insolvency, an administration or a liquidation. The appointed insolvency practitioner has a duty to try and recover that money from you. Now, obviously, I hope that you understand what your director's loan account is as of today. But if you don't, there's some ways that you can find out. The first one is pull a balance sheet off Xero, QuickBooks, Sage, whatever software you use. Free agent seems to be becoming more popular nowadays. And on your balance sheet, it's essentially a list of assets. And if you owe the company money, it'll either be in director's loan account or other debtors. That, as long as the software's up to date, will give you an understanding of what your director's loan account is as of today. If you haven't got that, maybe your accountant has or your bookkeeper has. Ask them. If you do not have any accounting software, it's a little bit more difficult to understand your position, but the first place I'd take you to is your last set of published accounts. And this is the danger with published accounts, is they're not a great deal of use to you to make decisions here and now to push your business forward. They're a snapshot of your business at some stage in the past. So you get your last set of accounts, and again, it'll be in the assets section. It could be other debtors. There could be a section that says directors, advances, and it'll show whether or not you have a DLA. Now, you might not have an overdrawn loan account in those last set of accounts, but here's the problem. It's probably, well, it's not probably, unless they were done yesterday, it's outdated information. So let's take an example of the 12 months out of date. Well, there's been 12 months of withdrawals and maybe deposits into that business from you personally or to you personally. So it's highly likely that director's loan account will have changed unless you've gone on salary. What happens for most people is they continue to take money out of that business. Let's say last set of accounts in March 2024, there was a 15 grand overdrawn director's loan account. Not as much of a problem at 15 grand. The director doesn't think he's got a problem. First thing I'm going to say to him is, well, what has happened since March 2024? And I use this example a lot just because it's easy. He takes 4 grand a month, £1 grand a month salary, 3 grand a month as what he classes dividends. but they're not dividends yet. They are drawings in anticipation of a profit, whereas accountant will declare a dividend. Now, here's the problem. He owed 15 grand into the company as of March 2024, but as of March 2024, he got behind paying the VAT. Didn't pay the corporation tax. He was insolvent on a cash flow basis. He couldn't pay his debts when they fell due. So everything that he's taken in his head as a dividend isn't a dividend. And it isn't a dividend because he hasn't made any profit. So, on appointment of the liquidator, they're then going to say to him, it's not just 15 grand that you owe, sir. It's actually 15 grand plus 36 grand. You owe the company £47,000. And that's a big problem. Because that insolvency practitioner, you know my thoughts on this, they're doing their job. Where I'm a little bit different is I'll tell you about this up front before you actually start work with us. But in most cases, this is left until the insolvency practitioner is appointed, and then the insolvency practitioner starts an action against this director to recover some or all of that director's loan account. Now, let's imagine that director has very little personal wealth. He has, rented accommodation, very little disposable income. Most insolvency practitioners will take the view, well, it's not really worth chasing this person. It's not worth the cost of the action compared to what we're going to get back to creditors. But let's imagine that you sat there and this situation resonates and you have a house with a lot of equity in. You may have buy-to-let properties. You may have savings. You're very vulnerable because the director's loan account is an asset that the insolvency practitioner has to try and recover to repay some money to creditors. Now, if you are well educated and you take note of what I'm saying, you can go to the insolvency practitioner or come to me and we can get a negotiated settlement on your director's loan account. When you're settling a director's loan account with an insolvency practitioner, what the insolvency practitioner has to get back is a better realisation than would happen in a bankruptcy. And again, if you've got no assets, you've got very little disposable income, it's very unlikely an insolvency practitioner is going to make you bankrupt. But again, if you're at the other end of the scale and you've got stuff to protect, when we start to factor in the cost of a bankruptcy, let's for argument's sake say you've got 300 grand equity in your property, okay? A lot of money that. But half of it's your partner's. So yours is 150 grand, okay. Now in a bankruptcy, your property it's called a for sale valuation. So you probably get sold for 10% less than what it's really worth. So you're now down to 135 grand. And then we've got cost to petition the bankruptcy, a couple of grand. You've got the trustee in bankruptcy's cost, which is 15% of any realisations. So we're at 135, let's say. We're probably at about 110 now. And then solicitors' costs against the director could rack up to, I don't know, let's say £30,000. So from a 300 grand equity house, we're now down to about 80,000. But you've got a lot of personal debt. And you've got £50,000 worth of personal debt that if you get made bankrupt, whatever's realised from your bankruptcy gets split out amongst all the creditors. And you've not paid the insolvency practitioner's fees either. And their fees could be up to sort of 20, 25, 30 grand even. So when you factor all that stuff in, you can understand now that actually in a bankruptcy, they wouldn't get anywhere near 300,000. And you can use that as a tool to negotiate with the insolvency practitioner. But if you get a deal done with an insolvency practitioner, because this happens, And what that deal looks like is you've got a negotiated settlement because the insolvency practitioner can justify taking less off you to avoid legal costs and hopefully get a quick resolution for creditors. Let's imagine you get the deal done, and then for whatever reason, you go into liquidation, you bury your head in the sand. You stop responding to the insolvency practitioner. You give them the two fingers. You don't respond to phone calls, you don't respond to emails, you don't respond to letters. Well, you've given the insolvency practitioner no choice. Like, they have to start a legal action against you. They may even sell the action to a litigation funder. And those people, they really know what they're doing. And if that happens, you've sort of set off a chain of events that you can't stop very easily. And the worst thing is, your settlement now, the solicitor's action has been started, will be a lot higher than if you'd have stuck to the original deal that you did with the insolvency practitioner and complied with them. So please, 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 if you're getting a deal done on a director's loan account, do not bury your head in the sand. You've got to follow it through. Another problem, and this was a real life one, there was a director I remember once, and he would just really coy about everything. A bit too tricky, a bit too clever. You know the type. They ring up for advice and they start telling you about what they need to do. And I'm thinking, why are you even ringing me? So this one guy, he bought his assets back. He did a pre-pack, so he liquidated business. He started another business. And he had a valuation done on his assets. And he had some terms to pay for the assets. And he just didn't. He stuck two fingers up to the insolvency practitioner. And in addition to that, this director's loan account that he just wouldn't release bank statements. Like, we're trying to help the guy understand his position. And he just completely blanked everybody and just, told them to go, you know what. Now, what happened with this guy, and he wasn't someone who didn't have a pot to you-know-what or a window to throw it out of. He was a wealthy guy. And it got to the point where the insolvency practitioner went, listen, we need to start an action against this guy. And what probably could have been settled for around £40,000, it went all the way to court. Just before court, it cost him £150,000. So, if you're given an opportunity by an insolvency practitioner, whether that's a settlement on your director's loan account, where you're paying over some terms, or you are buying some assets from the business, and again, you're paying some terms, the worst thing you can do is get into insolvency, appoint the liquidator, and stick two fingers up to them, because it always comes back to bite you on the arse. Hope you found the video useful. Please give us a call if you want some free, independent and impartial insolvency advice. My name is Chris Worden and I'm from Director First. God bless you.